Hello everyone, welcome to Economic Impact. Today is October 17, 2024, and as usual I am with our Chief Economist Stéphane Marion, who exceptionally is in Calgary right now and we are in distance. Hello Stéphane, how are you today?
Good morning, Denis. So we're doing this remotely this morning.
Yeah, remotely, exactly. Stéphane, we've been talking about the stock market for a while, and we said we should be prudent, but despite of that, the stock market keep going up.
Yeah, the enthusiasm is still there, Denis. We're hitting new all-time highs, and it's in many regions of the world driven by both expectations of more rate cuts by the central bank. So we're talking about the synchronized monetary easing cycle, and also expectations that we could have sizable fiscal stimulus from countries such as China that will help support global growth and obviously earnings going into 2025. But I have to say, Denis, there's a lot of these expectations that are already embedded in current valuations.
Mm-hmm. And at the same time, valuation are quite high compared to the past.
Yeah, so if we look at this slide and the little red, yellow dots shows the beginning of easing cycles in the U.S., and you can see that it's exceptional for the U.S. Stock market to be valued at 21 or close to 21 times forward earnings at the beginning of an easing cycle. So there's only one precedent for this such a situation, Denise. So again, we're navigating into unusual waters, if you want, and uncertain waters, I would say, when it comes to valuations on the stock market.
Yeah, and we're seeing on that graph that only 2 times out of 7 we saw the market going down after rates cuts, and it's interesting to see where we are in the cycle compared to the past. But also the next slide will show us how the market interpret what's going on in terms of valuation and volatility. And I would say the first 3 lines, that slide quite busy, but it's quite interesting because it shows as the market is doing different signal depending what you look at.
Yeah, so you're right. So the blue bar represents the range in which the market has traded in the past. The green line, if you want, the green number represents where we are now versus what you see on average in the other episodes. So you can see that the valuation is trading at almost 21 times forward earnings is quite high relative to the norm. The fact that earnings expectations are at 14% versus a norm of 10% means that we're expecting significant growth in the months ahead, and the stock market has not really corrected. Historically, the Fed starts cutting rates once the stock market starts correcting, which hasn't been the case this time around. So from a stock market, the first 3 bars shows that there's a lot of good news already expected in the stock market.
And at the same time, the last 3 bars are giving different signal. The one we call the moves is the volatility on the bond market, the VIX, the volatility on the stock market, and after that the corporate spread. And all of those data are below the line.
So historically, the market's a little bit nervous because the Fed starts cutting rates because maybe something's happening to the economy. So this time around, the stock market has already concluded that this is a soft landing, and other markets are saying it's going to be a perfect soft landing with no volatility. You can't get more perfect than this, Denis, because volatility for bonds or for the stock market is well below the historical average, and corporate spreads are the least stressed we've ever seen at the beginning of an easing cycle. So again, there's a very strong conviction in the markets that the soft landing is mission accomplished, and it only gets better from this point on.
Yeah, but there's probably a cloud above our head, because when you look in the United States, the very small business optimism is not there.
Yeah, so small businesses in the U.S., and we've said it before, the uncertainty index is important to look at because they account for 50% of job creation. So I do recognize that the latest jobs report in the U.S. was stronger than expected, But it seems like it broke the trend from the past 6 months, Denis. But I don't think 1 month makes a trend. So we'll have to see another good employment report before we change our mind on a potential stress on U.S. labor markets that could undermine profit expectations. But I have to say, people always claim that an election year is good for equities. It's been the case so far. I get this, Denis, but at the same time, we've never seen so much uncertainty prior to a U.S. election, and that's quite evident in this slide. So my point, Denis, here is, yeah, if we are going to change our view on the U.S. economy, let's wait for another jobs report. But more importantly, let's wait for the result of the U.S. election and to see whether it's contested or not by one of the two candidates. Both candidates could also contest it. We'll see that, Denis. So I think, going into the U.S. election, we've never seen so much uncertainty. And at the small business level, that should transpire theoretically with less aggressive hiring. But let's see the next job report to see if I'm right or not on that one.
Yeah, we won't wait too long because all of this will happen beginning of November. Then we'll know more really at the start of November about that.
So when we meet this next month in person, Denis, we'll be able to assess the whole situation.
Yeah, might be quite different. But if you come back in Canada, the story is a bit different where, the economy is not doing so well.
Yeah, so people are uncertain about this, the health of the U.S. economy. I have strong conviction that from a Canadian perspective, we're not that great. It's pretty weak. If you look at the manufacturing sector, it's stagnation. If you look at the service sector, it's contraction. So I know the latest jobs report in Canada, like in the U.S., was better than expected, but I think the uptrend on the unemployment rate is still intact. And that suggests that the Canadian economy is underperforming, Denis. So yes, we're looking at yet another quarter of weak growth in Canada. It's not a recession, Denis, don't get me wrong, but it's still below potential growth, and it's underwhelming. And underwhelming growth means higher unemployment in the months ahead.
But probably more bigger rate cuts has to come in Canada.
Yes, Denis, because underwhelming growth means that inflation is coming down quite significantly in Canada. So headline inflation surprised everyone at 1.6% only in September. Notice on this slide, Denis, if you exclude the mortgage interest rate component, which, the cost of financing your mortgage, inflation is only at 1%. But Denis, if you exclude shelter, on which the Bank of Canada has no control because of surging population growth, we're at 0.4%. Denis, that is extremely low. I cannot justify keeping rates where they are right now in Canada. I have to up the ante on rate cuts in Canada. 25 basis points is just too slow. They have to move 50 basis points increment.
And that's for the whole Canada. But if you go province by province, some provinces are not that great too, huh? They are in deflation situation right now, in territory deflation.
Yeah, actually, it's a good point. If you look at inflation excluding shelter, it's at 0.4%, so anemic at the national level, but there are 4 provinces we're actually talking about deflation. So prices are actually coming down. If you exclude the shelter component, those 4 provinces, Denis, it would be Quebec, Manitoba, New Brunswick, and Saskatchewan. So you rarely see so many provinces showing deflation. So as I said before, the Bank of Canada, despite the rate cuts, monetary policy is overly restrictive. They need to start cutting rates by 50 basis point increment because now, Denis, what they've been doing, they've been cutting rates, but inflation is falling faster, which means that you're not moving the needle on real interest rates. So 50 basis points would be my best guess for next week, and another 50 basis points after that. We got to come back to 3% very quickly to help the economy for next year.
Well, on that positive note for consumer, thank you very much for being with us, Stéphane, and hopefully next time we'll be close together in the same room. And thank you all for being with us. We'll see you next month, beginning of November. Thank you.